What if your favorite Nasdaq tech holdings could pay you a substantial monthly income without forcing you to sell any shares? That is the core appeal of JEPQ, the JPMorgan Nasdaq Equity Premium Income ETF. In this video, we break down exactly what JEPQ is, how it generates its payouts, the bull case, the real risks including NAV erosion, and how it stacks up against QQQ and JEPI. In my M1 Finance main portfolio, JEPQ ranks as my fourth largest holding. I started building the position on October 5, 2023. I hold roughly 115 shares, currently valued at $6,737. Those shares have delivered a total gain of $940.14 since then, including $660 in dividends earned, with a money-weighted return of 56.06%. Average monthly dividend payments from my position run around $64. It has become one of my favorite holdings because it layers reliable cash flow on top of broad Nasdaq exposure without constant management. If you want income with a meaningful growth, this ETF deserves close attention. JEPQ launched in May 2022. It is an actively managed ETF from JPMorgan with nearly $39.5 billion in assets under management as of July 20, 2026. The fund seeks monthly distributable income while maintaining exposure to the Nasdaq 100. Here is exactly how the payout is generated. The managers hold a portfolio of Nasdaq 100 stocks chosen using fundamental data science. They then run a disciplined options overlay by writing out-of-the-money call options on the Nasdaq 100 index. Those covered calls produce premium income that is distributed to shareholders each month. Recent payouts show the scale. The July 2026 distribution was $0.63658 per share, with ex-date July 1st and pay date July 6th. June paid $0.56444. The 12-month rolling distribution yield stands at 10.83% as of July 20th. The 30-day SEC yield reached 12.87% at the end of June. This is not a simple buy and hold Nasdaq ETF plus static calls. Active management lets JPM adjust call coverage and strikes dynamically based on market conditions. The goal is high income with some participation in Nasdaq upside rather than mechanical full overwrite every month. The expense ratio is 0.35%. Distributions come mainly from option premiums plus stock dividends. The fund has not distributed capital gains on a regular basis. Investors receive monthly cash while staying exposed to the growth sectors driving the Nasdaq. The bull case for JEPQ is direct. You receive a high distribution yield paid monthly while retaining exposure to the Nasdaq 100 growth story. That combination is difficult to replicate elsewhere. Tech and growth stocks have produced exceptional long-term returns, yet they rarely deliver meaningful current income. JEPQ monetizes the natural volatility in the Nasdaq through option premiums. When volatility is elevated, the premiums expand and the income engine strengthens. Active stock selection inside the Nasdaq universe adds another layer. The managers are not forced to hold every index name in exact weights. They can emphasize higher quality or more resilient companies while still running the call overlay. This flexibility separates JEPQ from purely rules-based covered call products. For investors who need or prefer current income, the monthly distributions are powerful. Early retirees or anyone managing cash flow can use the payouts for living expenses or reinvestment without selling shares. In my own portfolio, the roughly $64 average monthly dividend payments from my JEPQ position add meaningful, predictable cash on top of my larger growth holdings. The position I started building on October 5, 2023, has already generated $660 in dividends alone as part of its total gain. The strategy also offers a modest cushion in choppy or mildly declining markets because collected premiums lower the effective cost basis over time. During the higher volatility periods since launch, the income has helped offset some price pressure better than pure growth ETFs alone. With $39.5 billion in assets and strong third-party ratings, the product has earned broad adoption. For anyone with a constructive long-term view on tech and AI who also values monthly cash flow, JEPQ provides an efficient way to stay invested in the growth narrative while harvesting income. It fits portfolios that already hold core growth names and want an income sleeve without exiting the sector. The bear case for JEPQ rests on the built-in trade-off of every covered call strategy. High current income comes by surrendering a portion of future upside. In strong bull markets, that cost shows up clearly in performance. Since the May 2022 launch, JEPQ has produced attractive distributions, yet its price appreciation and overall capital growth have lagged the pure Nasdaq 100 tracker, QQQ, by a noticeable amount. A July 13, 2026 analysis from 24/7 Wall Street documented that investors following the monthly income approach have fallen 12.57% behind QQQ over the period. Other contemporaneous pieces frame the opportunity cost in the range of thousands of dollars per 10,000 invested. This lag reflects NAV erosion dynamics. When the Nasdaq rallies sharply, the calls JEPQ has written frequently move in the money. The fund captures gains only up to the strike plus the premium already received. Everything above that belongs to the call holder. Over repeated strong up months, the NAV simply does not keep pace with the underlying index. The high distributions arrive on schedule, but part of that cash flow is funded by foregone capital appreciation. Distributions have periodically exceeded what underlying price appreciation plus stock dividends alone would support. The result is gradual pressure on NAV during extended rallies. This is a structural feature of covered call overwriting, not a flaw unique to JEPQ. Investors who spend the income watch their principal compound more slowly than it would in a pure growth vehicle. Those who reinvest may narrow the gap on total return, but still face the opportunity cost versus simply holding QQQ. JEPQ also carries higher volatility than JEPI because of its concentrated Nasdaq and tech exposure. Sharp moves in AI or semiconductor names transmit directly into larger drawdowns. In taxable accounts, the distributions are taxed as ordinary income, reducing after-tax efficiency relative to qualified dividends or long-term capital gains. In low volatility regimes, option premiums compress and the distribution yield can decline. The strategy is not guaranteed income at any level. It performs best when volatility supplies rich premiums. If your primary objective is maximum long-term capital appreciation and you have decades of compounding ahead, the capped upside and measured NAV lag represent a real, quantifiable cost. JEPQ is engineered for income, not for beating QQQ on price return. As of July 20th, 2026, JEPQ NAV was $58.58, with a year-to-date return of 6.73%. The July distribution of 0.63658 per share went ex-dividend on July 1st. Mid-July 2026 brought several analyses examining the long-term trade-offs of the covered call structure versus pure growth exposure. QQQ remains the growth engine. It delivers higher total returns in bull markets with no upside cap and virtually no current income. It suits investors focused on maximum compounding over long horizons. JEPI applies the same covered call approach to the S&P 500. It offers lower volatility, typically lower yields in the 7 to 9% range, and more defensive characteristics. It fits conservative income investors who prioritize stability over tech concentration. JEPQ occupies the middle ground, higher yield than JEPI, direct Nasdaq growth exposure, and correspondingly higher risk. It suits investors who already hold core growth positions and want to add a monthly income layer without fully exiting tech. In my portfolio, with sizable PLTR and NVDA stakes, JEPQ fills exactly that role as the fourth largest holding, delivering consistent cash flow around $64 average per month. The position started October 5, 2023, shows solid money-weighted performance of 56.06% with strong dividend contribution. JEPQ delivers attractive monthly income layered on Nasdaq exposure through an actively managed covered call strategy. It works well when cash flow from growth assets is a priority, and you can accept capped upside plus potential NAV lag during strong bull markets. It is less optimal when maximum total return and long-term compounding are the sole objectives. If this breakdown clarified where JEPQ belongs in your allocation, comment below with your view on covered call ETFs. Subscribe for my weekly M1 Finance portfolio recaps and more ETF analysis. Link in the description to my latest holdings update. This is not financial advice. All investments involve risk, including possible loss of principal. Past performance does not predict future results. Conduct your own research and consult a qualified financial advisor before making decisions.